Welcome to this video, where we'll be diving into Chapter 4 of Benjamin Graham's classic book, The Intelligent Investor. This chapter is titled General Portfolio Policy, the Defensive Investor, and is all about setting up a solid foundation for the more cautious or risk-averse investor, what Graham calls the defensive investor. So, what exactly is a defensive investor? In this chapter, Graham paints the picture of someone who wants to minimize risk, avoid unnecessary volatility, and generate steady, predictable returns over time. A defensive investor isn't looking for home-run investments or trying to outperform the market by leaps and bounds. Instead, they're seeking a portfolio that will perform reliably in good times and bad, without requiring constant attention or the ability to predict future market movements. Graham's distinction between the defensive investor and the enterprising investor is key to understanding this chapter. While the enterprising investor might dive deeply into market research, seek out undervalued stocks, or engage in more aggressive trading strategies, the defensive investor has a more hands-off approach. Their goal isn't to maximize returns, but to safeguard their capital and earn modest but stable gains. The key focus is risk management, ensuring that the portfolio can weather downturns without significant losses. The balanced portfolio. The crux of Graham's advice for the defensive investor lies in creating a balanced portfolio composed of both bonds and high-quality stocks. Why is this important? Essentially, bonds are there to provide stability and steady income, while stocks offer the potential for growth. By holding both asset classes, the investor can reduce the volatility of their portfolio and avoid putting all of their eggs in one basket. Let's break this down further. Bonds are generally seen as a safer investment compared to stocks because they provide fixed payments over time. When you invest in a bond, you're essentially lending money to a government or corporation, and they pay you interest in return. At the bond's maturity, you get back the principal you invested. The beauty of bonds lies in their predictability. You know what you're going to get, and as long as the issuer doesn't default, you can count on steady returns. However, bonds aren't without risks. One of the biggest threats to bond investors is inflation. Over time, inflation erodes the purchasing power of fixed payments. If inflation rises, the real value of the bond's interest payments diminishes, meaning your money doesn't go as far. That's why Graham advises balancing bonds with high-quality stocks, which offer better protection against inflation in the long run. Now, what does Graham mean by high-quality stocks? He's talking about shares in well-established companies that have a long history of stable earnings and dividends. These are not the hot tech stocks of today that might rise or fall dramatically overnight. Instead, they're companies with solid fundamentals, strong balance sheets, and a proven track record of generating profits. Dividends are a crucial aspect of this strategy because they provide the investor with a consistent income stream, even if the stock's price remains stagnant or fluctuates in the short term. Allocating between stocks and bonds. One of the key points Graham makes in this chapter is that a defensive investor should always have a balanced mix of both stocks and bonds in their portfolio. But how should you decide what proportion of each to hold? Graham doesn't give a one-size-fits-all answer, but he does provide a useful guideline. He suggests that neither the stock nor bond component of your portfolio should ever fall below 25% or exceed 75%. In other words, depending on your risk tolerance and market conditions, your portfolio could range anywhere from 25% bonds and 75% stocks to 75% bonds and 25% stocks. The key is to maintain balance and adjust your allocation as necessary. For example, in times of market exuberance, when stock prices are soaring, Graham suggests shifting more of your portfolio into bonds to reduce risk. Conversely, when the market is in a downturn and stock prices have fallen, it might make sense to increase your allocation to stocks, as they're likely undervalued and offer more growth potential in the future. This strategy of adjusting your allocation based on market conditions helps the defensive investor avoid overexposure to one asset class and maintain a stable, diversified portfolio. Avoiding speculative stocks. Graham is very clear in his advice to defensive investors: avoid speculative stocks. Speculation, as Graham defines it, is purchasing assets with the hope that their prices will rise in the short term, without regard to the intrinsic value of the asset. Speculative stocks are typically volatile, and while they can deliver huge gains, they can just as easily lead to significant losses. Instead, Graham advises the defensive investor to stick to tried and true companies with a proven track record. This is all about risk management. By avoiding speculative investments, the defensive investor is protecting themselves from the possibility of large losses, which is the cornerstone of this conservative approach. The defensive investor should also avoid industries that are overly cyclical or subject to wild swings in profitability. For example, companies in the technology or energy sectors might experience boom periods when their products or services are in high demand, but they can also suffer sharp declines when market conditions change. Graham advises sticking to companies in stable industries like consumer goods, utilities or healthcare, which are less likely to experience dramatic swings in profitability. Simplicity and discipline. A key theme in this chapter is simplicity. Graham emphasizes that the defensive investor should keep things simple and avoid overcomplicating their investment strategy. You don't need to be constantly researching individual stocks, analyzing market trends, or trying to time the market. Instead, the defensive investor should focus on maintaining a balanced, diversified portfolio of bonds and high-quality stocks and let time do the work. Discipline is another crucial aspect of Graham's advice. It can be tempting to react to short-term market movements by making drastic changes to your portfolio, but the defensive investor must resist this urge. Instead, they should stick to their strategy, make adjustments only when necessary, and avoid getting swept up in market euphoria or panic. The defensive investor should also be wary of over-diversification. While diversification is an essential strategy for reducing risk, Graham warns that holding too many different assets can dilute the quality of the portfolio. The goal is to find a balance between diversification and concentration. Graham suggests that a portfolio of 10 to 30 high-quality stocks combined with bonds provides enough diversification to protect against individual stock risk while still allowing for meaningful growth. Perhaps one of the most important messages in this chapter is the importance of patience. Graham makes it clear that the defensive investor should not expect quick results. Building wealth through investing is a slow, steady process, and the defensive investor must be willing to wait for their investments to grow over time. This ties into another key point: realistic expectations. The defensive investor should not expect to achieve the same high returns as the more aggressive, enterprising investor. However, the defensive investor is also less likely to experience significant losses, which is a worthwhile trade-off for many. By maintaining a long-term perspective, the defensive investor can benefit from the power of compounding. Dividends reinvested over time can lead to significant wealth accumulation, even if the stock's price doesn't experience dramatic growth. Graham also stresses that inflation is a real threat to the defensive investor's portfolio, especially when it comes to bonds. Over time, inflation erodes the purchasing power of fixed-income securities, making them less attractive. This is why Graham advocates for holding high-quality stocks in addition to bonds, as stocks have historically provided better protection against inflation over the long term. By owning a mix of bonds and stocks, the defensive investor can protect themselves against the dual risks of market volatility and inflation. Stocks provide the potential for growth that can outpace inflation, while bonds offer stability and predictable income. Even though the defensive investor takes a more passive approach, Graham advises periodic portfolio reviews and rebalancing. Over time, the allocation between stocks and bonds may shift as one asset class performs better than the other. For example, if the stock market experiences a bull run, the stock portion of the portfolio may grow disproportionately, leading to an overweight position in equities. When this happens, the defensive investor should rebalance the portfolio by selling some of the overperforming asset class, in this case stocks, and buying more of the underperforming asset class, bonds, to restore the original balance. This disciplined approach ensures that the portfolio remains aligned with the investor's risk tolerance and long-term goals. In Chapter 4 of The Intelligent Investor, Benjamin Graham lays out a clear, straightforward strategy for the defensive investor. By maintaining a balanced portfolio of bonds and high-quality stocks, avoiding speculative investments, and adopting a patient, disciplined approach, the defensive investor can achieve steady, consistent returns while minimizing risk. The focus is not on beating the market, but on building a portfolio that can weather the ups and downs of the market over time.
Thank you for watching. Share this with friends and family, and please subscribe.